I'm Andy Panko, owner of Tenon Financial. Welcome to Retirement Planning Demystified. You've probably heard of tax loss harvesting, but you may not have heard of tax gain harvesting. Well, don't worry, because I'm about to explain what it is. But before we start, remember this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. When you have a normal brokerage account, you trigger off a tax event anytime you sell something inside it. If you sell something for more than what you bought it for, you'll have a gain. If you sell something for less than what you bought it for, you'll have a loss. Tax loss harvesting is when you consciously sell a position at a loss, so that loss can offset taxable gains you'd otherwise have that year. Basically, tax loss harvesting is a way to reduce otherwise higher income in taxes. If you'd like to learn more, check out my other video, What is Tax Loss Harvesting? On the other hand, tax gain harvesting is when you sell a position at a gain to take advantage of having low other income or taxes that year. If you hold a position for less than a year and sell it for a gain, you will have a short-term capital gain. And short-term capital gains are taxed at your ordinary income tax rates. But if you hold a position for more than a year and sell it at a gain, you will instead have what's called a long-term capital gain. And long-term capital gains are taxed at rates that are lower than your ordinary income tax rates. Or at least this is the case at the federal income tax level. This video is only referencing federal taxes, not state taxes, because each state could potentially treat capital gain taxation different from what's expressed here. For 2020, federal ordinary income tax rates go up to 37%, but long-term capital gain tax rates are either 0, 15%, or 20% depending on your level of total taxable income. Here are the long-term capital gain tax rates and their respective taxable income thresholds for both single and married filing joint taxpayers. As you can see, if you're single and your total taxable income is up to and including $40,000, you'll pay zero tax on the portion of your long-term capital gain within that threshold. If your total taxable income is over $40,000 and up to and including $441,450, you'll pay 15% tax on the portion of your long-term capital gain that is within that band of total taxable income. And if your total taxable income is over that level, you'll pay 20% tax on the portion of your long-term capital gain over that threshold. And here you can see the corresponding taxable income thresholds for couples who are married and file a joint tax return. Let's walk through an example to make more sense of this. We'll assume a single person. If your total taxable income is below $40,000, any long-term capital gains included in that will be taxed at 0%. And then long-term capital gains within your total taxable income between $40,000 and $441,450 will be taxed at 15%. Please note that this graph is obviously not to scale. And finally, if your total taxable income is above $441,450, long-term capital gains above that level will be taxed at 20%. It's important to note that capital gains are stacked on top of your other ordinary income. For example, assume you have a pension that pays you $40,000 this year, and that's your only other source of income for the year. On the surface, it looks like that pension completely fills up the first threshold of $40,000. But don't forget, you're allowed to reduce your income by either itemized or standard deductions to arrive at your taxable income. For purposes of this example, I'll assume you use the standard deduction. And I'll assume you're under 65 years old, which means in 2020, your standard deduction will be $12,400. After subtracting your standard deduction from your gross income, you're left with only $27,600 of taxable income for the year. That means you have a taxable income hole of $12,400 that you could potentially fill up with long-term capital gains that will be taxed at 0%. So maybe you take some of your highly appreciated stock you've held in your brokerage account for many years and sell a portion of it to take advantage of that zero tax rate. In other words, you would opportunistically harvest some of that gain to fill up that tax bracket for long-term capital gains. So assume you sell enough of those shares that you'll have a long-term capital gain of exactly $12,400. That gain would stack on top of your other $27,600 of taxable income, bringing you right up to the $40,000 threshold, which means all $12,400 of that long-term capital gain will be tax-free. You'll still have to pay normal income tax on the other $27,600 of income, but you just took advantage of the ability to pay no tax on your gain. This is tax gain harvesting. In the example, you filled up your total taxable income inclusive of your long-term capital gain right at $40,000, no more, no less. But what if you intentionally or accidentally sold an amount of shares that gave you $20,000 of gain? In that case, the tax on your gain will be tiered. In other words, you would basically break that total gain into two, where the dividing line would be the $40,000 threshold. Any portion of the gain below that will be taxed at 0, and any portion above it will be taxed at 15%. This is why it's important to be aware of the stacking concept, where long-term capital gains are stacked on top of your other sources of ordinary taxable income. Because like in this graph, this stacking idea helps you better visualize how the taxation on your gain may be broken up into tiers or chunks, so that some of the gain is taxed at one rate and some of the gain is taxed at another. So, tax gain harvesting sounds great so far, but you may be asking, well, what if I like the position and want to continue to hold it for the long term and don't want to get rid of any right now? Well, that's a good question. The beauty of this is that once you sell the position, you can immediately turn around and buy it back. So you can end up holding just as much of the position as you did before you harvested some gain. But now, you took some of the unrealized gain off the table and paid 0 tax on it. Therefore, your future gains will be based on the new higher price as opposed to the original lower price. This is called resetting your basis, where basis is the formal term for your cost in a position. So, when should you consider doing tax gain harvesting? Basically, you can consider it anytime you have taxable income that is lower than you anticipate it to be in the future. But ideally, the best time to do it is when your other taxable income is really small, so you can take advantage of the 0% long-term capital gain tax level. So as you saw, that 0% level has a pretty small taxable income threshold, $40,000 for single persons and $80,000 for married couples. If you're still working, it may be difficult to keep your taxable income under those levels. With that said, retirees can often have great opportunities to take advantage of tax gain harvesting, particularly in cases where your wages have ceased and you have not yet started receiving pensions or Social Security, and you're not yet 72, which means required minimum distributions from your tax-deferred accounts have not yet kicked in. During this period, it's possible you will have 0 taxable income or really close to it. That would be the perfect time to sell some of your appreciated positions in your brokerage account and potentially pay 0 tax on those gains. And if you want to continue to hold those positions, you can. Just simply buy them back at the current prices right after you sell them to reset your basis. Before wrapping up, I'd like to add one more comment to this topic. Tax gain harvesting only applies to normal taxable brokerage accounts, not tax-deferred accounts like IRAs and not Roth accounts either. Because with tax-deferred and Roth accounts, there are no tax implications of selling positions. Instead, in the case of a tax-deferred account, you're taxed when you take distributions from the account, but it doesn't matter what you did inside the account to generate the cash for that distribution. And with Roth accounts, you typically don't pay any taxes on them anyway, so there aren't any taxes on the gains in the first place. Well, that's it for tax gain harvesting. I hope you found this video helpful. If you haven't already, subscribe to this channel so you can be the first to know when new videos are posted. And don't forget to subscribe to my monthly newsletter, Retirement Planning Insights, which provides informative retirement planning tips and info. Also, be sure to join my free Facebook group, Taxes in Retirement, where you can learn all about tax-efficient retirement planning. Thanks for watching. I'll see you soon.